There's a window during retirement, and for those that have spent 20 to 30 years building a retirement account, often they have no idea that this exists. And for those that do know about it, well, a lot of times they sit in it and do nothing. Here's what the window is. Between the year that you stop working and the year that you turn 73, the federal government is not forcing you to take money out of your pre-tax retirement accounts. That means no required distributions, no mandatory tax bills. Instead, it's just a period of time where your income could be lower than it has been during your adult career, and that window can be a tax planning opportunity. And for a number of people, it might be the most valuable one they will ever have. Now, what I'm talking about are Roth conversions, what they are, why the timing matters more than the amount, and who's this strategy actually relevant for. Let's first just take a quick look at tax brackets. So here's a look at the 2026 federal income tax brackets. This is how progressive tax brackets work. Let's just take a look at the married filing jointly. So what it really means is that they're getting taxed at 10% on the first $24,800 in that tax year. And then they're taxed 12% between $24,801 and up to $100,800. But in this case, I'm saying they brought in $100,000. So really they paid 12% from $24,801 up to $100,000. So they're in the 12% tax bracket. However, they're not paying 12% on the entire amount that they make because they paid 10% on the first $24,800. Hopefully we got that straight. Now, while so many understand the basic difference between the traditional IRA or 401k and a Roth account, let's cover a couple of key points here. Pre-tax accounts. Let's say your traditional 401k, your traditional IRA, you put the money in before you pay taxes, it grows, hopefully. You pay taxes when you take the money out in that retirement. Now, Roth accounts, they work in the opposite way. You put money in after you pay the taxes, and then that grows on a tax-free basis. And then you pay nothing when you take that money out. So a Roth conversion is the act of moving money from a pre-tax account to a Roth account. You pay the income tax on whatever you convert in the year that you convert it. And in exchange for that, the money now grows on a tax-free basis and comes out tax-free for the rest of your life. Now, that's the mechanism. Simple enough. The question is never really, should I have a Roth? The question is, when does it make sense to convert it, or how much? And what does it cost you to do it in the wrong year versus the right one? Let's take another look deeper. Now, here's where most people miss it. The value of a Roth conversion is not really about whether the Roth is better than pre-tax in the abstract. It's about the rate at which you pay the tax to convert. So let's take that married couple. During their working years, they're earning about $350,000. And then after the standard deduction, their taxable income is around $320,000. Now they're sitting in the 24% tax bracket, with the top of their income pushing into the 32% bracket. Now, if they convert $100,000 from a traditional IRA on top of that income, that conversion gets taxed at 32 cents on the dollar. But if we took that same couple, they retire. Now, they're not drawing Social Security yet. RMDs have not started. They're pulling $120,000 from their portfolio to sustain their lifestyle. So after the standard deduction, their taxable income is closer to $90,000. And they're sitting in the 22% tax bracket with room to fill before they hit the next threshold. So if they convert $100,000 that year, they're paying 22 cents on the dollar instead of 32 cents. And then on a single $100,000 conversion, that's about $10,000 in tax savings. Now you run a disciplined conversion strategy across 5 years in that window, and now you're looking at $50,000 in cumulative tax savings on the same dollars, just moved at a different time. That's not a loophole. That's called bracket management. So you are choosing to pay tax at a rate that you control rather than waiting to pay it at the rate that the government sets later. Let's go back to the slides. This is the forced distribution problem. Now, this is the part of the conversation that often lands hard. A traditional IRA or 401k, it's not yours to hold on to forever. At 73, the IRS requires you to start taking the required minimum distributions called RMDs. The amount is calculated based on your account balance and your life expectancy factors. So you don't get to choose the amount. You also don't get to defer it. You take the distribution and you pay it as ordinary income tax. Now, for someone who has spent 30 years contributing into a 401k and has, let's say $1.5 to $2 million in a pre-tax account. Here I'm showing $2 million. Those RMDs can be substantial. So at $2 million balance, the IRS uniform lifetime table It produces an RMD of roughly about $75,500 in the first year. If you add Social Security to that, which may be partially taxable at that level of income, and that same couple who retired expecting lower taxes, they find themselves right back in the bracket that they thought they had left. Now, the result is that some people spend their entire careers in a mid-range tax bracket. They retire expecting relief and then find themselves back in the high bracket at 75 because of the size of the account that they built. The account worked, the tax planning did not keep pace with it. Now, a Roth conversion strategy executed in the years between retirement and RMD age, it reduces the pre-tax balance that generates those forced distributions. So smaller pre-tax balance, it means smaller RMDs. Smaller RMDs means you control the taxable income in your 70s and your 80s. So the Roth conversion strategy is not universally the right move for everybody. Context will determine whether it makes sense. It tends to produce the most value for people who have a meaningful gap between their retirement income and what their RMDs will be at age 73. The wider that gap, the more room there is to convert at a lower rate. It also works better for people who have assets outside of that retirement account to pay the tax bill on the conversion. Using IRA funds to cover the tax you owe on the conversion, it reduces the amount that ends up in the Roth and it kind of erodes the benefit. Now, it's less compelling for people whose retirement income is already high. Think about people who have ongoing consulting income, rental income, a pension, or a working spouse with significant earnings. If the bracket gap is small, the rate differential, it may not justify the complexity. State income taxes are also a real factor. So some states, they tax Roth conversions. Depending on where you live, the blended rate on the conversion, it changes the calculus. So that's a variable worth running before executing a strategy. And then finally, there's legislative risk worth stating here. See, Roth accounts, they're currently tax-free on distribution under current law, but tax laws can change. In fact, tax laws do change. So advisors or tax professionals, they're usually putting these plans together on current law as a baseline, but with the assumption that permanent tax-free treatment, it's not a guaranteed thing. Now, that's not a reason to avoid the strategy. It's just a reason to stay informed. So the concept's not complicated. You have a window where your income is lower than it probably has been and potentially lower than it will be again once required distributions start. So a Roth conversion lets you use that window intentionally, paying tax at a rate that you choose rather than a rate that the government assigns you later. Now, whether it makes sense depends on your specific numbers, your pre-tax account balance, your tax rate today, your projected income at RMD age, and how many years of runway you have in that window. Those are all factors here. So what I would encourage you to do is just find out whether you're even in the conversation. Pull your pre-tax account balance together. Think about what your income might look like in the first few years of retirement before Social Security and RMDs layer in, and then ask a professional whether the gap is worth addressing proactively. This is not advice specific to your situation. It is a mechanism worth understanding. So if you go deeper on how this fits into your picture, that conversation, it starts with your specific numbers. Now, if this was useful, subscribe. There's more of these that are coming.